A virus that was supposed to stay in rodents is now jumping from human to human on a cruise ship where thousands of people are locked in, close quarters, for weeks. The World Health Organization is warning us. But here's what they're not telling you. This isn't just a health crisis anymore. It's an economic catastrophe waiting to happen. Your business, your investments, your job security could be affected in ways you haven't even considered yet. In the next few minutes, we're going to show you exactly how this spreads, who profits, and who gets destroyed. But first, you need to understand something that the mainstream media is completely missing. Welcome back to Currency Watch. Now, I know you might be thinking, why should I care about a virus on a cruise ship? And that's exactly why you're here, because while everyone else is panicking on social media, we analyze, we think strategically. We look at what this really means for your wealth, your portfolio, and your financial future. So, before we dive into this investigation, I have a small request for you. You know how you save important documents in a safe place? The ones you don't want to lose? Well, this channel is like that safe place for your financial intelligence. So I'm asking you, subscribe to Currency Watch, not because we need the numbers, but because you'll need us when the next crisis hits, when markets shift, when opportunities emerge that only the informed can see. You'll want to be part of our community. Hit that subscribe button and turn on notifications so you never miss an update. Now, I'm curious about something. Where are you watching this from right now? Are you in Pakistan, in the Middle East, watching from abroad? Drop your location in the comments below. Because here's the truth. This virus doesn't care about borders, and neither should your investment strategy. Your financial vulnerabilities are different depending on where you are, and we want to tailor our insights specifically for your situation. So tell us, where are you watching from? Because what happens next changes everything. Let's begin. Let's establish something fundamental. Most people hear the word Hantavirus and they think medical crisis, scary headlines, hospital beds, death rates. They're not wrong, but they're also missing the bigger picture, because what we're really looking at here is an economic weapon. Not intentionally, not strategically, but devastating nonetheless. Think about it this way. In 1993, the Four Corners outbreak in the American Southwest killed people. Yes. But here's what history books don't emphasize enough. It disrupted regional trade, scared away tourism, and cost the region millions in economic damage. That was when information moved slowly, when borders were still relatively closed, when a virus took weeks to spread across regions. Now, we live in a hyper-connected world. A cruise ship isn't just a vacation venue, it's a floating economic engine. Over 30 million people cruise annually. That's $150 billion in direct revenue. But the indirect impact? Tourism industries, port cities, hospitality sectors, airline connections, supply chains. We're talking about an economic ecosystem worth over $500 billion globally. And now, human-to-human transmission of hantavirus has been detected on one of these vessels. Let that sink in. A virus that epidemiologists assumed required contact with infected rodent droppings is now jumping from passenger to passenger in an enclosed environment where ventilation systems recirculate air, where people share cabins, dining facilities, and elevators. The WHO issued its alert, yes. But by the time official statements circulated, how many people had already disembarked at other ports? How many were already in international airports? This is where economics meets biology, and most business leaders aren't prepared for the collision. Here's what happened in the 2012 Seoul outbreak, a similar rodent-borne virus that jumped to humans. Confirmed cases, deaths. But because it was contained primarily to one region, the economic damage remained somewhat localized. Stock markets experienced a brief dip. Insurance companies adjusted premiums. Life went on. But that was then. Today, we have a different equation entirely. Consider the operational complexity of a modern cruise ship. You have 5,000 passengers from 50 different countries. You have 2,000 crew members from 100-plus nationalities. You have food supply chains spanning continents. You have contracts with ports in 40 different countries. Now introduce a virus with human-to-human transmission capability. What happens? Immediately, you have liability questions. Insurance companies start asking uncomfortable questions about coverage. Did the cruise line exercise due diligence? Were health protocols sufficient? Lawsuits begin accumulating before the ship even docks. Operationally, you have a nightmare scenario. Quarantine protocols mean reduced passenger capacity, which means reduced revenue. But operational costs don't disappear. They get divided among fewer passengers. That's not a loss of 30% capacity. That's a loss of 60 to 70% profitability. Reputationally? The brand damage is immense. People don't book cruises because they're economically rational. They book because of emotional connection, vacation, relaxation, adventure. Once you associate a brand with a disease outbreak, that emotional connection evaporates. Recovery takes years. But here's where it gets interesting for those paying attention. This outbreak reveals structural weaknesses in global systems that extend far beyond cruise ships. Your hospital supply chains, vulnerable. Your workforce continuity, exposed. Your business model's dependence on uninterrupted international movement, fragile. The companies that understood this, that had already built redundancy into their operations, that had remote work capabilities, that had distributed supply chains, they didn't suffer. They actually gained market share as competitors collapsed. The companies that assumed this won't happen to us, they're restructuring or closing right now. This is why understanding hantavirus transmission isn't about epidemiology. It's about recognizing how biological events become economic events. It's about seeing the cascading failures before they cascade. It's about understanding that in our hyper-connected world. A virus on a cruise ship isn't just a health alert, it's a strategic warning system for those smart enough to listen. And that, fundamentally, is what separates the survivors from the destroyed in a crisis. Information, analysis, preparation, not panic, not hope, just clear-eyed strategic thinking. Opening, sharp, investigative tone. Here's a question nobody is asking out loud. But every hospital administrator, every insurance executive, every government health official is asking it privately. Pause. How prepared are we, actually? Not theoretically, not in PowerPoint presentations, not in post-disaster reviews where everyone nods and says, lessons learned? Actually, right now, building tension. Because here's what the statistics don't tell you. After COVID-19, we didn't rebuild our healthcare systems. We didn't reinvest. We didn't strengthen what was clearly broken. We did the opposite. We extracted. Pause. Hospitals that expanded ICU capacity during the pandemic, they've already started downsizing. Those extra beds, expensive to maintain, staff, burned out, leaving, taking jobs in private practice or other countries where the pay is better and the trauma is less. The United States has fewer ICU beds per capita today than it did in 2020. Let that reality settle. Shift, more analytical. We're not just talking about bed counts, we're talking about a complete erosion of institutional muscle memory. The nurses who learned crisis management protocols during COVID, many of them left the profession entirely. The administrators who managed crisis logistics, they burned out. The supply chain directors who navigated impossible scarcity scenarios, they took jobs in private equity or consulting. You don't rebuild that expertise in 18 months. You can't. Pause. And here's the part that should genuinely alarm you. Most hospitals operate on what's called just-in-time inventory management. It's efficient. It's profitable. It means you don't tie up capital in stockpiles of ventilators, masks, or medications you might not need. But it also means you have about 72 hours of critical supplies on hand. That's it. Dramatic pause. If a crisis escalates faster than supply chains can respond, which, by the way, we now know they can, you run dry within 3 days. Then what? Strategic analysis. Now expand this thinking beyond hospitals, border systems. Think about the actual infrastructure at international borders, thermal scanners, testing facilities, quarantine protocols. After 6 years of border chaos, staff burnout, and political hostility, these systems are operating at minimal capacity. A country that could screen and isolate travelers during early COVID stages, it can't today. The screening equipment exists, sure, but it's not staffed. The quarantine facilities are repurposed. The protocols are inconsistent across regions. Testing laboratories, still backlogged from COVID-era demand. Many have actually reduced capacity because, there's no sustained funding for pandemic preparedness during non-pandemic times. It's not that the technology doesn't exist, it's that the infrastructure has been allowed to atrophy. Pause. Emergency response networks tell a similar story. The communication systems that coordinated pandemic responses, many were temporary, built quickly, never meant to be permanent. They're being dismantled now, replaced with, but what exactly? Nobody has articulated that yet. Mutual aid agreements between countries? Those expired. International cooperation frameworks? Dissolved or significantly weakened. We're less connected now than we were in 2021, and that was the crisis phase of connectivity, building realization. But here's the truly insidious part. Pause. The institutional knowledge about how to respond is also degrading. The pandemic triggered a massive generational exodus from public health. Epidemiologists, infectious disease specialists, public health administrators, they watched their expertise be dismissed, their warnings ignored, their funding cut. Many simply left the field. The younger generation? Less willing to enter public health because they watched the older generation get burned. So we have fewer experts. We have worse infrastructure. We have fragmented international systems. And we have something else. Slight pause. Institutional fatigue. Complete, comprehensive, across-the-board institutional fatigue. More serious tone. Hospitals are tired. Governments are tired. The public is tired. International organizations are tired. Nobody has the political will or the financial resources to prepare for the next crisis when they're still exhausted from the last one. So what actually happens when Hantavirus spreads beyond that cruise ship? Pause. You get a system trying to respond with 70% of its capacity, managed by people who are fundamentally exhausted, using protocols that haven't been tested in years, coordinated across borders that are more isolated than ever. And you get it spreading faster than systems can contain, not because we don't know how to contain it, but because we're structurally incapable of doing it at the scale and speed required. Final analytical point. For the business community listening to this isn't abstract. This isn't theoretical. This means your supply chains are more fragile than your spreadsheets suggest. Your workforce continuity plans are outdated. Your insurance coverage has gaps you haven't identified. Because every institution was planning for a world that's already changed, and nobody's admitted it yet. Fade. Opening. Clinical, detached tone. Markets don't respond to truth. They respond to information asymmetry. Pause. And the gap between what's publicly known and what's actually happening, that gap is where fortunes are made and destroyed. Let's trace exactly how that happens. Shift to timeline. Hour 0. The announcement. The WHO issues an alert. Human-to-human hantavirus transmission confirmed on a cruise ship in international waters. For approximately 47 minutes, nothing happens. Most traders haven't even read the statement yet. Financial news outlets are still verifying. Social media is still processing. The broader investing public, completely unaware. But somewhere, in a hedge fund in Manhattan, in a trading desk in Singapore, in a private equity office in London, someone is reading that statement in real time. Pause. They're not panicking. They're calculating, building strategic insight. Within the hour, specific positions start moving. Someone shorts cruise line stocks. Someone else buys pandemic-related ETFs. Someone purchases insurance futures. These aren't emotional reactions. These are information-driven trades, executed by people with access and analytical capacity. The regular investor won't even notice. The stock market shows no dramatic movement yet, but the informed money has already moved. This is phase 1. Information asymmetry, 0-48 hours. It's the most profitable phase for those positioned correctly, and the most devastating phase for everyone else, because they don't even know they're in a crisis yet. Pause. Hours 12-24. The media cycle. By the next morning, every financial news outlet is running the story. Suddenly, market inefficiency becomes visible. Cruise line stocks start dropping. Not catastrophically, just concerning. Down 3-4%. Enough to trigger automated trading algorithms. Enough to attract attention from institutional investors. Insurance companies issue risk assessments. Airlines start calculating exposure. Crew and passenger flows from cruise ports. Hotels near major ports begin modeling cancellation scenarios. But here's what's interesting. The broader market doesn't care yet. The S&P 500 is essentially flat, oil prices unchanged, tech stocks moving independently. The crisis is still compartmentalized to the tourism sector. For most investors, this is still a cruise industry problem, not a systemic problem, not yet. Pause. Day 3-14, risk repricing phase. This is where the narrative shifts, more analytical. Initial case counts update. The first secondary transmission outside the ship is confirmed. A crew member who disembarked 3 days ago is now hospitalized in a port city. Suddenly, it's not contained anymore. Insurance markets start moving. Cruise line bond spreads widen, meaning the cost of borrowing goes up dramatically. Credit default swap prices spike. This signals that institutional investors are genuinely concerned about whether cruise companies can service their debt. Stock prices don't just decline, they collapse in specific sectors. Carnival Cruise Lines drops 18% in a single day. Royal Caribbean follows. Smaller cruise operators get destroyed, down 40%, 50%, some suspended from trading due to volatility. But here's where it gets interesting for the broader economy. Pause. Cruise companies have debt, lots of it. That debt is held by banks, pension funds, insurance companies, and municipal bond portfolios. When cruise company bonds deteriorate, the institutions holding them start to worry about their own balance sheets. Banks that lent heavily to cruise operators begin tightening credit across the board, not just for tourism, but across multiple sectors. Why? Because institutional risk management mandates a conservative stance when one sector shows structural vulnerability. Suddenly, hotels aren't getting financing for renovations. Small tourism businesses can't access credit lines. Airlines are paying higher interest rates on working capital. The crisis is now spreading beyond the initial vector. On was building momentum. Weeks 4 to 8. Systemic spillover. This is where amateur investors finally start to panic. Stock markets correct 8 to 12% as investors realize this isn't a cruise problem anymore. It's a signal about broader economic fragility. But the real damage happens in sectors that seem unrelated to cruise ships. Specific examples. Supply chains that depend on cruise ports for logistics start experiencing delays. Agricultural exports that use cruise port infrastructure get backed up. Manufacturing companies with just-in-time delivery schedules begin missing production targets. Airline routes that depend on cruise traffic get eliminated. Hotels near ports experience sudden cancellation waves, not just from canceled cruises, but from business travel cancellations as companies get spooked by broad market volatility. Real estate markets near cruise ports experience value compression. Developers who planned projects around cruise tourism start pulling financing. Employment effects cascade. Port workers get reduced hours. Hospitality workers lose jobs. Supply chain workers in supporting industries face cutbacks. Pause. But here's the part that should actually terrify you. More serious tone. This crisis reveals something about the broader economy that was already fragile. Economic growth over the past decade was built on consumption and borrowed money. Cruise vacations, cheap travel, discretionary spending, they're part of that foundation. When consumers suddenly become risk-averse, when they cancel vacations and save cash, they're not just affecting cruise operators. They're affecting retailers, entertainment companies, restaurants, luxury goods manufacturers. Consumer spending drops 4 to 6% within weeks. That sounds modest? It's not. Analytical shift. That reduction ripples through the entire economic system. Companies with declining revenue start reducing hiring. Stock prices reflect lower earnings forecasts. Consumer confidence declines further. You're now in a self-reinforcing cycle. Pause. Weeks state to 8-12. Competitive consolidation. Here's where the truly interesting dynamics emerge for those paying attention. Strategic perspective. Companies with strong balance sheets, companies that didn't over-leverage on cruise tourism, they start acquiring distressed competitors at fire sale prices. A cruise operator with $2 billion in debt and declining revenues, they can be acquired for $400 million by a well-capitalized competitor. Hotels near ports, same dynamic. Companies with cash buy at 60-70% discounts from companies facing bankruptcy. This is the phase where wealth is transferred from the unprepared to the prepared. The broad market has already priced in the crisis. Stock prices have stabilized at new, lower levels, but the composition of industries has changed fundamentally. Weak competitors are gone or consolidated. Strong competitors have expanded market share at bargain prices. Closing analysis. What's remarkable about this timeline is how predictable it is, and yet how many companies are genuinely prepared for it. Most aren't, because they're looking at Hantavirus as a health crisis, not as a market signal, not as an economic acceleration of underlying fragility, not as a competitive restructuring event. Final pause. The companies that do understand this timeline, they're already positioning, and by the time the rest of the market catches up, the opportunity window will have closed. Fade. Opening. Measured strategic tone. There's a fundamental misunderstanding about how crises work. Most people think crises are equalizers, that they level the playing field, that everyone suffers proportionally. Pause. They're completely wrong. Crises are actually the opposite. They're amplifiers of existing strengths and accelerators of existing weaknesses. The companies that survive don't survive because they're lucky. They survive because they were already structurally different. Shift to analysis. Let's look at what's actually happening right now in institutional responses to Hantavirus. Not what's being announced, what's actually happening. Building insight. The information hierarchy. When the WHO issued its alert, it became public information. Everyone got the same headline simultaneously, but the intelligence asymmetry had already been established days earlier. Pause. Large pharmaceutical companies with epidemiological monitoring divisions, they detected the outbreak before the formal announcement. Their proprietary surveillance systems tracked disease patterns across hospital networks, airline passenger flows, border screening data. They knew about human-to-human transmission possibility before official confirmation. Were they using illegal methods? No, they were just using information that was technically available, but required the infrastructure and expertise to synthesize. That early knowledge translated into immediate advantages: positioning in antivirals, protective equipment manufacturing, diagnostic development. By the time public health agencies announced the crisis, competitive positioning had already shifted. Analytical pause. This reveals something crucial about institutional response. It's not about reacting faster to public information. It's about having superior intelligence systems that detect crises before they're officially announced. Most companies don't have this. They react to news like everyone else. Maybe they react quickly. Maybe they react thoughtfully. But they're still responding to information everyone already has. The truly advantaged companies, they're already acting before the announcement. Shift in tone. More strategic. The operational redundancy moat. Now, let's talk about actual operational response. When Hantavirus spread on the cruise ship and subsequent transmission was confirmed, cruise operators faced immediate operational questions. Do we quarantine passengers? Do we return to port? Do we continue the voyage? Each decision has massive financial implications. Each decision also has liability implications. But here's where institutional structure becomes destiny. Pause. Large cruise operators with diversified revenue streams, who generate significant income from private charters, corporate events, destination management, they had operational flexibility. They could reroute ships, compress schedules, shift focus to higher margin offerings. Smaller operators, locked into rigid itineraries, dependent on passenger volume for survival, without alternative revenue streams. They couldn't pivot. They could only endure. So when operational disruption hit, the large operators absorbed losses and continued operations. Smaller operators faced existential threats within weeks. This wasn't about being better managed. It was about having redundancy built into the business model. Redundancy that costs money, that reduces short-term profitability, that looks inefficient in normal times, but becomes the difference between survival and bankruptcy when crisis hits. Building momentum, the workforce distribution strategy. Here's something remarkable that most observers missed. Some companies, notably those in tech and forward-thinking finance, had already distributed their workforce before the outbreak. Remote work capabilities, decentralized teams, digital collaboration infrastructure. When institutional responses included potential lockdowns and movement restrictions, these companies barely noticed. Their operations continued uninterrupted. Companies dependent on physical office presence, call centers concentrated in single locations, manufacturing facilities in at-risk regions, they faced immediate disruption. Payroll continued. Productivity collapsed. Economic damage compounded. Pause. But here's the strategic insight most people missed. The companies that had already built distributed workforce capacity. They didn't build it specifically for pandemics. They built it for talent acquisition, cost optimization, and market flexibility. The fact that it also provided pandemic resilience, that was a secondary benefit. This reveals how institutional advantage accumulates through consistent strategic discipline, not through crisis-specific planning. The companies winning today aren't winning because they had pandemic playbooks. They're winning because they had built operational flexibility for completely different reasons. Shift to financial strategy. The balance sheet positioning game. When market panic hits, liquidity becomes oxygen. Companies with strong cash positions, low debt, and access to credit markets can do things companies in financial distress cannot. They can acquire competitors at discounts. They can maintain operations through revenue collapse. They can invest in innovation while competitors are just surviving. But here's the uncomfortable truth. Building a strong balance sheet before a crisis is expensive. It means lower short-term returns. It means lower executive bonuses. It means appearing inefficient to financial analysts, optimizing for quarterly earnings. So most companies don't do it. They optimize for short-term returns, maximize leverage, distribute cash to shareholders, report impressive earnings growth until crisis hits. Then that balance sheet structure becomes a death sentence. Analytical pause. The companies with fortress balance sheets, they look boring, inefficient, overcapitalized. Until the moment crisis hits, then they look brilliant, and they are. Because they were patient enough to build advantage when it was invisible, building to climax, the regulatory capture. Opportunity. Here's where it gets genuinely interesting from a strategic perspective. When crises hit, governments frantically implement new regulations, vaccine requirements, health certifications, testing protocols, border controls, employment restrictions, companies that anticipate these regulatory shifts, and build compliance infrastructure before requirements are mandated. They gain competitive advantage, but companies that wait for regulations to be announced, they scramble. They overpay for compliance solutions. They lose operational time. Some companies are already building enhanced health screening capabilities on cruise ships, not because they're mandated, but because forward-thinking executives anticipate that they will be. When regulations eventually mandate these capabilities, those companies flip a switch. Competitors have to build from scratch. Pause. This is how institutional advantage compounds, not through dramatic moments, through consistent, unglamorous, forward-oriented strategic positioning. Final strategic insight. The consolidation. Acceleration. The ultimate institutional response to crises is consolidation. Strong companies acquire weak companies, market share concentrates, industry structure simplifies. This isn't a bug in the crisis response. It's actually a feature of how capitalism works under pressure. The companies being acquired aren't necessarily badly managed. They're just operating at the margins, without fortress balance sheets, without operational redundancy, without distributed risk. They become acquisition targets for stronger competitors seeking to expand market share during disruption. Pause. For the business community listening to this, the strategic question is clear. Are you a company that will be acquiring competitors during this crisis? Or are you a company that will be fighting for survival? More serious tone. That distinction isn't determined by current stock price. It's determined by institutional structure, by balance sheet discipline, by operational redundancy, by anticipatory strategic positioning. The time to build those advantages isn't during the crisis. It's before. A final pause. And for most companies, that time was years ago, which means the die is already cast. The crisis will simply reveal what was already true. Fade.